You're tuned back into Agriculture Today, and we continue our show with K State grain economist Dan O'Brien and the senior economist at the IGP Institute, Guy Allen. Dan, Guy, as we continue this grain market conversation, wanting to pick it up with talking domestically about wheat.
Yeah, the supply demand balance sheet for wheat had just minor changes. Again, we're not really measuring, the USDA isn't at this time measuring size of crop, so that's all pretty set. The only thing that can change supply is really imports, and that did happen. Well, I guess some adjustment in old crop ending stocks and then imports. We did see an increase of about 5 million metric ton of wheat, up to 120 million. That on top of 1.97 billion. And this is for the 24-25 mark year. That began May of 24. It'll end, pardon me, that began June 1st of 24. It'll end May 31st of next year. So not a lot of change there. A slight increase because of some industrial surveys, the food sector, food and milling sector, a slight increase in wheat usage for domestically. No change in exports. I think the big story on wheat is that uh, 2 years ago, we exported 762 million bushels out of the U.S. of wheat overall. Last year, 707. You had international things that Guy probably you'll talk on, and affected that this year with some of those same areas of the world being impacted. Now we're anticipating about 825 million, and out of that for hard red winter wheat that we had here, which is a lot of what we're dealing with in Kansas. We have some other soft red coming into and others, but but for hard red winter, we only had 134 million bushels of exports last year. This year, we're projected to be about 220. So anticipate to be a little better situation. Some of that has to do with the Black Sea region. Guy, go ahead on the internationals.
Yeah, on the international side, look, globally, we're looking at a record world wheat crop production this year. USDA increased it by zero point 0.6 million metric tons up to 790, just under 795 million metric tons last week. Shaved a bit off of a bit of production. Most of it was unchanged. Ukraine and Russia was steady to just slightly lower. EU production was steady. Exports were left unchanged at 30 million metric tons. That's compared to nearly 38 million metric tons last year. Argentina was shaved a 500,000 tons. Exports left steady at 11.5. Australia, down there in the southern hemisphere with Argentina, both starting to bring some harvest off. USDA number was unchanged at 32 million metric tons for Australia, even though the recent attaché number was at 28 and a half. My local contacts down there suggest it's probably going to be closer to the 32 than the 28. Canadian production was left unchanged. And exports were steady at 26 million metric tons. And the key one in this was China's crop, unchanged, 140 million metric tons, but they did lower imports to 11 and a half. That's versus 12 and a half last year. The feeding number for 24-25 was surprisingly brought down to 33 million metric tons compared to 37 million metric tons last year. That left us to leave us with world ending stocks 257.6, just slightly lower than last year. So not too many changes on that, giving us our ending world stocks to use ratio at 32% versus 32 last year. So pretty much unchanged on the wheat. Just one comment going back to our corn comment. I think particularly in the U.S., we're going to see a bit more wheat feeding this next year than last. Just giving, particularly when we get to new crop, that's when we generally see our biggest wheat feeding numbers at first quarter, July, August, Sep. So I don't know. You
Guy,
have any comment
eh,
on that, Dan?
yeah, if I can add, well, the wheat feeding thing situation could work out for sure that way if U.S. exports are not if they don't hold up to these USDA projections, and in fact, if some of the things that could happen in corn after the first of the year, usage wise, come in and tighten up stocks more, that well, yeah, then wheat's sitting right there sorghum might be too. I would add in, Guy, on again the number that you like to look at, the stocks to use for major exporters. That thing is that's tightening up just like corn is. So you got in 2022, 23 market, and we were just about 13.8% stocks to use for major exporters. Last year, 11.4. This year, 8 8.9%.
Yeah.
So just almost amazingly tight. And of course, the thing that we've been talking about for a while, which is kind of incredulous if we trust the world numbers, that world less China stocks to use 18.9%. It was 21% 2 years ago, 20 and a half. So that thing keeps tightening up. And so I think that if the market has worries about what could happen in a place like the Black Sea region, some drought, ongoing geopolitical issues, who knows what, then it's likely to be the market's likely to be sensitive in coming months to whatever comes out of that. Now, that probably takes us over into our geopolitical discussion as to what would happen with the new administration about the conflicts over there. Guy,
Just
you have
I'll
any
give
comments on that?
Yeah, a couple macro comments before we can move to the geopolitical ones is I think one thing that on wheat, particularly internationally, is just the impact food inflation's having on that, particularly in a lot of those wheat consuming countries. Wheat being a food grain, a lot of these importing countries have seen quite a bit of food inflation. I think we're seeing a bit of drop back in demand because of locally higher prices on that. And I haven't quite got that completely figured in there, but it is having an impact. Looking at transportation situation, few changes there. Just quick look at the dry bulk index. Freight's slightly firmer to steady for last month. Index is up at $1,634, which is a little bit firmer, but look, it's been pretty steady. Starting to resolve some issues there at the Panama Canal with a few more transits going through. Starting to see a few dry bulk vessels go through there, but most of it's still container sort of vessels, but it's good to see that. Looking a bit closer to home, though, the biggest impact we're seeing on your local basis at your country elevator. One bit of rain charged the lower Mississippi with a bit of water, so they've increased the drafts. I think it's back up to 12 feet compared to 9.5. Significant drop in barge freight, which is adding value to that river basis. Also, a lot of pressure has come off then the rail car market as we saw the premium for rail transportation come back as well. Part of that's because harvest is wrapped up and has been put away pretty tight, but that should be improving our country elevator basis. And I think we'll continue to see that as we move to the beginning of the new year in 2025. So starting to narrow that spreads up on the board there as well.
Guy, what about for currency?
Oh, currency. Yeah, glad you mentioned that. Look, currency, since they've announced Trump projected to win the election on the night of the 5th. U.S. dollar index has jumped 3%, a big jump. It jumped about 2% that night. Today we're up about above 106.5. Keep in mind that the biggest drivers of that are the euro and the Japanese yen. And I think it's also making, our big importer currencies is having a bigger impact on that. And that's definitely what's hanging over these commodity prices the last few days. And the reason they've been moving a bit lower is that big jump in our foreign exchange, because it's just making U.S. grain a bit more expensive on that.
Dan, Guy, when you guys look at the grain market, what are some headlines you're seeing around it?
Guy, let me throw out the first one, then you can respond to it. Just one an important ag article came out here that in the last few days that the title was Trump trade policy seen as wild card for U.S. soybean farmers, opportunity for crushers. What do you think of all that?
Well, I think this concern over a trade war and tariffs is being a bit one misrepresented and misstated. Trump's been very specific at you utilize tariffs to level the playing field. I think a lot of us fail to realize that there are significant import tariffs for of 65% going into China once you're above the TRQ for corn, for wheat, about 45% or better for animal products such as beef and pork, and that just doesn't seem to be like a level playing field. And I think strategically placed tariffs to bring particularly China and other countries that have fairly high import tariffs back to a more level trading field trading field is the place to go. And it's interesting to watch him starting to appoint his cabinet members this week and the people he's putting in there. And we'll see who he puts in there in the U.S. Trade Representative and the Secretary of Ag. But I think, Trump knows how to make a deal. I think he strategically utilizes those. He can definitely level that playing field for agricultural trade.
I would add in also something on a little different, related but a little bit different. Another headline that Mexico reinstates food price controls. They've had some dry conditions. Guy, you mentioned in the first segment that Mexico is now the #1 U.S. export market, if anything, at least more stable than what we see right now going on with China, with more issues having to do with trade conflicts, trade tensions. So, and we have our tensions with Mexico too, with regard to GMO corn and you name it. But still, it's I guess if I had a comment on that, it's that if they're having economic struggles in Mexico, it's not from an altruistic point of view, altruistic sense, to have relatively low price grain temporarily anyway, it probably helps that situation down there. But we'll see. Any comments on that, Guy?
Yeah, just looked at food, the price controls there in Mexico. I think that's quite symptomatic of a lot of countries that are experiencing fairly high food inflation, which we're seeing that in the U.S., but a lot of other countries have seen that in a significantly greater extent. Um, the other comment I'd like to add, going back to the trade situation, if in a tariff situation, if they're strategically placed, um, it doesn't change the total world demand, say, for corn or soybeans. Um, we're still going to have that same demand. So what you'll see is the profile of U.S. exports may shift and change to other alternative destination. And it's not like we're losing that whole market. It's just a freight spread. We'll still export the same volume of soybeans will hit the world trade, or corn will hit the world trade. It'll just shift to an alternative destination, say to Europe, North Africa. And that's not an absolute loss of market. That is just a change in the underlying freight spread. Now that's likely to hurt us a bit, but it's a few dollars a ton. It's not, and a lot of the analysis I've seen, they've done the calculation, oh, we'll lose all of the Chinese market, or we'll lose all of this particular market. Well, the U.S. may lose that destination, but it will shift to an alternative destination. And I
We
think
kind of
that
shift the flows around a little,
it'll
shift
shift
the
the
flows
flow.
around to compensate.
And when we had that, 4 years ago, well, 6 years ago, I was a bit surprised how long it took the export market we saw the price drop, and it took them about 60, 90 days to figure that freight spread shift out. I think the trade's a lot more attuned to those potential threats and issues. And I think those spreads and those alternative markets, look, they've got established relationships there now, and that'll happen very, very quickly.
Dan, Guy, I appreciate you both taking the time to join us today.
Thank you, Shelby.
Thank you.
That was K-State grain economist Dan O'Brien and the senior economist at the IGP Institute, Guy Allen. We're cutting to a short break now on Agriculture Today, but we'll be right back.